What's up guys, in today's video we're going to be talking about the foreign exchange impact on my trading 2-on-2 investment portfolio. Because as you all know, I use my hard-earned Great British pounds to invest into US stocks. Now whilst one of the key parameters for success when investing is certainly by looking at the returns on investment of the stock itself, you also have to consider the impact of exchanging my Great British pounds for that of US dollars in order to invest into United States companies. The reason being it can have an extremely good or an extremely bad impact on the overall returns within your investment portfolio. So let's talk about it, but before I do so guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys, it really helps out the channel. With that being said, let's dive straight into it. So FX rates and investing, how does it all work? Well, foreign exchange rates are actually a very simple concept to understand. Essentially it's the value of one currency versus that of another, and it's usually depicted into what's formerly known as a currency pair. So as an example, you have the Great British Pound against the United States dollar, you have the Euro versus the Great British Pound, and you have the Great British Pound versus the Japanese Yen, and many other different combinations. And the value of those currencies fluctuate on a day-by-day basis. And in actual fact, they fluctuate on even smaller time frames than that, because the FX market is actually the most liquid market in the world. Now there are certainly benefits and drawbacks to a strong versus a weak currency when we look at it from an economic standpoint. But the big question here is, how do FX rates affect our trading 2-on-2 investment portfolio? Well, let me explain. Well, you guys know me and you know my investment portfolio pretty well. I invest heavily into United States stocks such as Apple, Amazon and Tesla. Now because those stocks are US listed companies, they don't accept Great British Pounds, which is my domestic currency when I'm looking to buy shares within those companies. So whenever I do go and place an order to buy more shares, trading 2-on-2 actually converts my Great British Pounds into United States dollars in order to make those investments. Now you may think Apple, Amazon and Tesla have performed greatly this past year, and you would certainly be right in saying so. Because as you guys can see from looking at my investment portfolio, we've got Apple, which is up 30.3%, we've got Amazon up 8.5%, and then finally if I scroll down, we've got Tesla who are up 91.95%. But unfortunately those returns aren't exactly painting the full picture, because when I convert my Great British Pounds to United States dollars, I can either win or lose depending on the overall strength or the weakness of the Great British Pound versus that of the United States dollar. To put this into perspective for you guys, if I take a look at my Amazon investment and if I scroll down, I can look at the return being that 8.6%, but if I actually expand that return, you can see I've actually lost on the FX rate of 5.47%, or the equivalent of £95. The same goes when I click on Apple. The return again is at 30%, but the FX impact is a loss of £81 or 5.27%. And finally, the very same goes for Tesla. The stock is actually up 96.45%. However, the FX impact, I've actually lost 4.5%, or the equivalent of £57. Now that's quite a substantial amount when you look at the actual percentage return figure, and even when you look at the pound amount figure too, it's the equivalent of a couple of £100. So how does it all work? Well, fundamentally, if the United States dollar devalues versus that of the Great British Pound, I'm actually losing money. The reason being, I'm converting my more stronger, more valuable Great British Pound to buy into a devaluing currency in order to buy a stock. And we can see how this FX impact has played out over the course of this past year by comparing the strength of the United States dollar to that of the Great British Pound. So if you'd invested near the lows of the market in March 2020, well, the United States dollar has lost roughly 16% of its value against the Great British Pound since then, which means if you'd taken your hard-earned Great British Pounds and used it to buy a United States stock, you would have needed a minimum of a 16% return on investment just to break even. Now this does seem pretty mind-boggling when you think about how difficult returns are to come by in the stock market, let alone when you throw in the FX impact too. But to be honest guys, it's not always been this way. In actual fact, the United States dollar over the course of the past 10 years was actually the stronger currency, which means you actually would have been better off taking your Great British Pounds and investing into a foreign stock over in the United States, simply because you would have benefited from the FX impact alone. Now to give you guys the numbers for additional perspective, if you'd taken your Great British Pounds and used them to convert into United States dollars in order to invest into United States stocks, back in January 2011 you would have gained an additional 18% return on your investment over the past decade, simply because the Great British Pound was comparably weaker to that of the United States dollar during that period. But here is where the potential danger lies. Back in the early 2000s, the Great British Pound was the far stronger currency of the two. And during the period of 2001 to 2007, the United States dollar actually lost 32% of its overall value against that of the Great British Pound. Meaning any UK investor during that period investing into the United States stock would have suffered greatly from exchange rate losses during that period. So there are certainly a couple of key things to mention during this point in the video. The first one being exchange rates are massively volatile and really unpredictable. That's because currency valuation fluctuates on the basis of monetary policy decisions as well as government decisions too. As an example, the Great British Pound absolutely sunk to 31-year lows after the Brexit referendum back in 2016, but has recovered ever so slightly over most recent months in light of a Brexit deal being announced. But then you also have the UK monetary policy to consider too. The Bank of England announced base rate would go to 0.1% back in 2020, which means with lower interest rates, it's actually encouraging spending within the economy. And with increased levels of spending, you get higher levels of inflation. And when you have higher levels of inflation, the currency actually devalues. And similar things are going on over in the United States with the Federal Reserve, who have simply been printing money like it's going out of fashion. And that's to predominantly provide stimulus packages across the United States of America. Now, the byproduct of printing money, or to use the economic term quantitative easing, is the fact that when you increase the supply of something, fundamentally that thing becomes devalued. And I'm sure most of you guys have probably seen this chart by now, but it shows that over the course of 1913 to 2013, the United States dollar has actually lost 95% of its purchasing power. So what can we do about the exchange rate losses, which I'm sure most of you guys have probably experienced if you're a UK resident investing into US stocks over the course of the past 12 months or so? Now, I really don't want to go down into the detail of some of the investment strategies in which you could use, but here are a couple of high-level options. The first one being actually hedging within your trading 2-on-2 investment portfolio. Now, one of the biggest hedges against the devaluation of a currency is actually investing into commodities. The rationale being it's a scarce resource that should hold, if not increase in value over time, rather than losing value like that of a currency. By nature, it's a deflationary asset, and because of that, investors do like to invest into commodities when there is stock market uncertainty, or to simply offset some of the risk from the exchange rate losses within their investment portfolio. The second key thing that you could look into is more diversification. If you really have the time and the expertise to dig into the currency valuations of different currencies, and if you think that the United States dollar will continue to devalue against that of the Great British Pound, you could possibly think about investing a little bit more into some of your domestic stocks over here in the UK, until FX rates swing the opposite way, where actually the Great British Pound is devaluing against that of the United States dollar, at which point you would gain from an FX impact from using your Great British Pounds to invest into United States stock. But fundamentally, there's always going to be a little bit of a balancing act between the two currencies. The third and the final thing is to simply be aware of it, but don't get too fixated on it, because it's one of the uncontrollable elements of investing. For me personally, investing into superior stocks and the returns in which those stocks will provide over the course of the long term should always outweigh any kind of FX loss that you would be impacted by due to fluctuations in the value of a currency. What I do have to consider within my own investment portfolio is that over the course of the past 9 or 10 months or so, I've actually invested in one of the worst times to actually buy into US stocks when we look at it from an FX rate perspective. But despite that, I've still seen really strong gains on the portfolio overall, with the portfolio itself being up well over 20% in the last 12 months alone. And to be honest guys, over the course of the long term, I would expect that gap to grow, whereby we compare the returns on investment of the stocks in which I've invested into versus that of some of the minor FX rate losses. And when I say losses, they're not really losses, because they're just unrealized fluctuations within the investment portfolio. Obviously now the US dollar is the weaker of the two currencies. However, over time things might reverse, and that FX impact could actually provide me with additional return on investment. So there's certainly lots of things to consider here guys when we're looking and thinking about the FX impact on our trading 2-on-2 investment portfolios. And there's lots of different approaches that you can take in order to mitigate your risk or fundamentally change your overall investment strategy. But do let me know guys down in the comment section below some of the strategies in which you use to mitigate some of that risk when we're looking at FX rate losses within an investment portfolio. Similarly, let me know guys if it's something that you've actually ever considered before, or whether it's something that you simply just brush over. And with that said guys, if you did enjoy the video, be sure to drop a like on it, as well subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.